Welcome to the Banyan Edge Podcast. Here's your host, Charles Sizemore.
Welcome to the Banyan Edge Podcast, America's #1 source for safer, smarter, more profitable investing, where we aim to bring you the very best insights from the very best minds in the business, completely filter-free. I am your host, Charles Sizemore, and today we are taking out the trash. Of course, my friend Adam Odell in his recent Banyan Edge article used more colorful scatological language, but we are referring to some of the problem children of 2022. Some of the stocks that got beat up the most 2022 have been rallying the hardest these 5 weeks into 2023. Tesla, fine example, up over 50% already. Peloton, the indoor bike maker, they're up over 100% year to date. And of course, my personal favorite, Carvana, is up about 200% year to date. Now, our own Charles Mizrahi had some rather, every time I see Carvana in the press, I can't help but think of Charles's very apt description here. He referred to it as a Pez dispenser for cars. That's such a colorful metaphor there. And it is a company that has never had any possibility of turning a profit, never will, never has. It doesn't matter. And indulge me here for a minute. I actually know a little bit about used cars. One of my grandfather's businesses back in the day was he actually owned a used car lot. And so he would, this is Carvana's deal, is they claim to have what they would call geographic arbitrage. They would find cars that are in oversupply in certain markets and then buy them up and then sell them in markets where there's high demand. And that sounds good. And people in the business actually do that. My grandfather, if he knew that a certain make and model was popular in his area, Fort Smith, Arkansas, and he knew that they were in oversupply somewhere else, he'd cram his crew into the cars. They would drive out there like clown car style. And then each guy would get in a car that they bought and drive it back to sell, rinse and repeat. So the model does work if you actually do it. The issue is Carvana wasn't doing that at all. Like they were paying a premium rather than getting these cars cheaply and selling them expensively. They were paying out the wazoo. It was a business model that's hopelessly flawed from the beginning. Yet this stock is up 200% this year. Now, Adam, I know you have some very clear thoughts on this. You wrote about it recently in Banyan Edge. What's going on? Is Carvana suddenly profitable? Have they somehow managed to figure out this business model in the last 5 weeks?
No, absolutely not. And it's not just Carvana. On this list of stocks that did the best in January include Wayfair and Zillow Group and Open Door. The last two, Open Door and Zillow Group, they were doing this iBuyer program where they're basically doing the same thing as Carvana, buying inventory off the market at a above market rate price and then trying to sell it. They were basically just a loss leader for trying to grow their companies. But the bigger story here is that I did analysis of the 1,000 largest stocks, the Russell 1000, the 35 stocks that did the best in January. They had basically rallies from 33% up to 115%, with Carvana being the most. This group of stocks were the stocks that did the worst in 2022. So 2022 was one of those years that, Warren Buffett said, when the tide goes out, who's swimming without shorts on. And that's really what we saw in 2022. It was some companies like Carvana who have a failed business model and were never profitable. And you also have profitable companies like Tesla, but that just traded at insanely high valuations. I mean, at one point in 2021, Tesla traded at a price to earnings ratio of 1,103. So it's absolutely insane. So really what we saw in January was kind of a reversal of 2022. And to me, that shows short covering. A lot of folks piled into short trades on the stocks that were absolutely tanking throughout 2022. And then in January, they all seemed at once to want to start booking their profits. So they started booking their profits by buying shares of those stocks back. And that caused the rally that we're seeing in these junk stocks.
I remember Carvana, I looked at this fairly recently. The short interest was over 50% of the float. It was hovering between 50 and 60%. So, in plain English, that means you had this massive pool of forced buying that had to happen because everybody that shorts a stock has to buy it back. It's not like they have the choice to buy it back. They have to. That's what happens when you sell a stock short. You're actually borrowing the shares with the understanding that you will be buying them to pay them back. Now, Ian, I know before you started writing about investments, you had, you were in the trenches as a hedge fund trader. You've seen some stuff. I mean, I know you've seen some of this in the wild. Can you tell us a good story?
Tell us a good story. I've seen some stuff that's fairly accurate.
Like war stories here. I've seen things.
Yeah, well, I just want to take put a little perspective though. Just sometimes one person's trash is another person's treasure, right? So like there are a lot of companies right now that obviously for one reason or another might not be here 3-4 years down the road, but there's a lot of babies that have been thrown out with the bathwater, if I can use another metaphor. And, I always think back to like the realm of possibilities when you're thinking about investing, right? And where are you going to have like some type of asymmetrical upside? And like the case that you guys are making, I mean, I'm not a big fan of Carvana, and I agree that, the business model is inherently flawed, even though they were making more money on flipping these cars than some of their competitors at the time. And also, the Carvana, the reason why they've lost so much money is because they basically were buying cars when the Manheim car used price index was at its high, and then the thing dipped. And, it's hard to make money. If the used car prices are going up and you're acquiring them along the way, you'll make money. But I think back to like, we had a similar bubble like in 2000, 2002, where we had this, brand new wave of disruptive companies, lots of innovation, everything from .com. And, also there were networking companies that were involved as well in that big tech bubble in 2000. But, there were some opportunities at the lows of those bear markets that were absolutely historic and generational. And the reason why not everyone is able to capitalize on, let's say, 1,000x return in Amazon is because it's very hard, right? It's hard to hold on to these stocks when they're near the lows. You see these crazy amounts of volatility where, you have months where the thing goes up 50%, and the next month it's down another 50%. But, there will be some companies that emerged from this time period that we look back and say, oh my God, I just wish I bought that one. Right. And I heard the same things about Amazon back then. I didn't buy Amazon because everybody said, oh, the company's not profitable, they'll never make money.
They called it the river of no returns, and that seems so ridiculous now, of course, but that was the snide comment at the time.
Yeah. And just think about like how the Gartner hype cycle works. So you have this technology trigger, this brand new technology, and then it forces a mania. And basically, all of a sudden everybody realizes that the expectations that they had for the company or the technology isn't arriving tomorrow. And they sell. And then you have the kind of period we have now. And then slowly things emerge, and these companies in the technology start to see real world adoption. And then you get this like longer term trend, which is, I believe, what you saw from Amazon, basically from the .com lows until where we are now. Obviously, Jeff Bezos, has done much more than e-commerce, and I think they make 30% of their profits from the cloud right now. So, there's no like direct comparison to Amazon, but I'm just saying that we've seen a similar scenario unfold before, with what you think is trash becomes somebody else's treasure.
No, for sure. But part of what we're seeing beyond that, when you see it rip this quickly, it's usually not new buyers that are big believers in the company. They come later. What we're seeing at this stage is more that short covering. Yeah, and Adam, I remember this was fun. Like you and I actually made some money on this not that long ago. It was early 2021, around the time there was that epic short squeeze in GameStop. And you actually recommended National Beverage, the maker of LaCroix. And one of the factors that we listed for a potential catalyst that could really send that thing to the moon was the high short interest at the stock at that point. And it's not like we knew it was going to get squeezed. No one ever knows, but we knew that given the high short interest, that was a really good potential catalyst. And what was our return in that? It was January. I remember when it was January 2021. We were up like 100% in a month, weren't we?
Yeah, we locked in gains of over 100%, basically within a day. I mean, it happened within months of us getting into the position. I mean, I want to be clear that in that service, we were buying stocks for the long run. We were using my 6-factor rating model to find stocks that rate well in momentum, quality, valuations, growth, et cetera. And Fizz was the ticker, FIZZ. Yep. It rated in the high 80s. So it was a company that we wanted to own. But sometimes in our research, when we do our due diligence, we find these factors that are kind of like the cherry on top, so to speak. And this, I think it was like 35 days of short interest, meaning that if all of the short sellers began at once to start buying back shares of the stock that they were short, because they were taking too big of a losses. If they all started buying back, it would take 35 days of the average volume in that stock for those shorts to be covered. And really, when you see a situation like that, you know that the price can absolutely just scream higher if these short sellers all, call uncle and kind of fold all at once. So that's really what we took advantage of there. But I mean, whether it's a short squeeze by shorts that are taking a bath on their position, or whether it's short covering by shorts that are taking their profits, the message at the end of the day is you want to figure out what's causing the price to go higher. Is it shorts unwinding their position? Because if that's what you're buying into, it's probably a short-lived rally. Otherwise, if it's long-term serious investors that are buying because the valuation of the stock is wonderful, then that's more sustainable. So that's really what I see in January as a rally that isn't sustainable, because I believe that most of it is people either covering their shorts, or people who are trying to, whatever they fell in love with in 2021, they're waiting on a Fed pivot just to pile back into the same exact stocks in 2023. And I don't happen to think that's going to work across the board either.
Yeah, these aren't people buying these stocks because they see them as long-term investments. Now, some people may be, of course, but when you see this kind of spike, like that's what it is. These are short-term traders that are sort of obliged to buy. Now, where this gets fun, and we've all made money going long in stocks. We've all made money going short in them, but this short covering dynamic, it really boosts the volatility, which makes for some interesting setups. I think that's really kind of what makes this what makes this interesting. Now where you can get into trouble. So let's say you've identified a stock that's run up, too far, too fast. It's not sustainable. Like everything, all of your models tell you this is not a sustainable rally. Going short can be problematic for the reasons we discussed. Like when you see these squeezes, you don't want to be one of the shorts getting squeezed. So even if you're betting against a stock because you have every reason to believe this thing is going lower, you can still get squeezed. So Adam, I know that you don't get squeezed. You've made several good positions on the long side and the short side over the last year, and getting squeezed was never really part of the equation for you. So how do you manage that risk? How do you mitigate that?
Yeah, it all matters what vehicle you use. I have never, in my more than a decade of writing newsletters for regular investors that subscribe to our research, I've never once recommended selling short actual shares of stock. And the reason I do that is that your potential profit is capped at 1x, basically 100% if the stock goes to zero. Whereas if your potential losses or your risk could be 2x, 3x, 5x, 10x, it could be 20x. So really the asymmetry of risk and return is not in your favor. You're trying to pick up $1, but you're risking $3, $4, $5 potentially. I like the relationship when it's in the reverse order. So basically for the past 10 years, if I do see a short opportunity, if I see a stock that's just priced too high, or a market that's rolling over and I want to bet on a decline in the price, I've been basically helping my subscribers buy put options. When you buy a put option, your risk is limited to 1x, but your potential return is 2x, 5x, 10x or more. So really that's the way I implement a short. And most of the time we're going long. I mean, I'm an optimistic, cautious optimist that likes to play on the bull side as well. But last year we saw, a number of opportunities to be on the short side of the market. And that was one of the few things that worked last year. So.
Yeah, no, I think. And I would, let me just jump in here for a second. So,
sure.
I would also note that given the time period that we are now, very similar to 2000, 2002, like I said, you had 13 short squeeze or, bear market rallies, whatever you want to call it, of 20% or more in the NASDAQ. And, I think the climax of that was after 9/11, which, I worked in Lower Manhattan at the time. And I remember we closed the markets for a week and we got back to work. The market had this huge sell-off. I think the Dow was down like 1,500 points or something like that, which was pretty significant when the Dow was 8,000. The market rallied 40% off that over the next 3 months, but we still were in a bear market, and then it rolled over again. So, I think this year is going to be one of those years where it's really tricky. You're going to have these huge moves up in a lot of stocks that everyone thinks is, are done. And then the volatility will continue on both the long and short side. But, as somebody who kind of made a name for myself on the short side of the market during the financial crisis, shorts are way more fun than longs because the profits come so much faster. Because, the escalator up, which means the market slowly grinds higher normally, an elevator down, if you are in the right put position, in short, I know you don't like to short stocks, and I prefer puts too, because you make money on the volatility as well. If you're in the right puts, and let's say the stock drops 10, 15, maybe 20% in another couple of days, depending on how long your timed expiration is, how far out of the money is, you can make like 10 to 20x sometimes in some of these put positions. So, and these are like the kind of like tradable markets that we're seeing right now for that type of strategy.
No, that's exactly it. And it is funny. Like, we're basically three guys that are pretty bullish generally, but we do see opportunities on the short side from time to time here. And Adam, so kind of piggybacking on what Ian was saying there. So you get these setups. I know that you see one now. Like, we've talked about it. Like, you believe what, this big rally in January that we saw that's bled over into February. You see that this is kind of setting us up for a really kind of epic trade here. Why don't you give us some detail on that?
I couldn't have said it better myself. I see opportunities on both the long side and the short side. Some of the services I run are long only. We have a small cap service where we're buying small cap, higher growth stocks, and we're trying to use the bear market to get in at good prices and position ourselves for the inevitable next bull market. So that's certainly what we're doing on the long side. But last year I put on a number of short positions via put options, and we were 9 for 9 profitable on our exits last year. The company I have in my sights right now is profitable. It's better than Carvana. It's better than a lot of the completely garbage stocks out there. And that's really what's misleading about it, is it has this kind of illusion of profitability. It became profitable in 2020 for the first time for a full year. Its profits are growing quickly. It kind of became one of the poster childs for the bull market in 2020 and 2021, the kind of the climatic stage of it. But the problem I have with this company is its valuations. So it's valued more than like 5 or 6 of its competitors all combined. At one point last year, it was trading at a price to earnings ratio of 1,103. So really, I mean, the price, it doesn't matter how good a company is. It doesn't matter if they're leading a revolutionary technology. It doesn't matter what their growth rates are. Really, at the end of the day, if you pay way too high of a multiple in that stock, it's either dead money or it's going to be moving against you, going lower. So really, I believe that, last year was kind of the year that everybody stopped paying the high price to earnings multiples, and we're seeing that compression. And then I think that it's going to continue this year in some of the most, expensive stocks.
Yeah, no, that's been one of your themes of the last, actually couple months now, was just compression. Some of the, the high multiples that were made possible by essentially free money from the Fed, et cetera. We're in a different environment now, and that, it is natural that we've had compression, and it's natural that we'll have some more, particularly in some of these names. Now, I think I think that kind of sums that up. I do know we've had some questions come in here, and Adam, I'm going to let you field this first one, because this is actually in direct response to one of your articles. This is a really long question, so I'm actually going to summarize it a little bit, but this is referring to foreign markets. James writes in to say, in regard to your Banyan Edge piece from January 27th, what is not discussed by Odell, probably because he wasn't born yet, is why foreign markets had upsurges in his chart cycles of U.S. equity outperformance. The difficulty in predicting when to bail out of foreign markets is much more risky than Odell makes it sound, for all kinds of reasons. Look at Alibaba, for example. Far more volatile is the power of the dollar and the Fed to flip those markets on their head in an instant with announced, or worse, unannounced policy changes. What becomes of a diversified whole market portfolio then? So kind of boil this down into a very simple question.
Yeah. I'll summarize it. I'll jump in and summarize that. I wrote a piece recently how U.S. stocks do not always outperform foreign stocks over certain cycles. That it's a cycle where you get bouts of outperformance from foreign, and then there's a part of the cycle that you get parts of outperformance from U.S. And we've just finished a 15 to 16 year period where U.S. stocks outperform. So most investors that have been in the market for the past couple of decades kind of make this assumption that U.S. stocks always outperform, like we're guaranteed to outperform, or like we're entitled to outperform foreign markets. So I was actually alive when foreign markets outperformed between 2000 and 2007. China's big build out, EM, emerging markets, and China did well during that period, outperformed U.S. stocks. So I'll counter that little shot. But is investing in foreign markets somewhat riskier than investing in U.S. stocks? Potentially, but that's also why you get excess return during certain parts of the market. So I'm looking at valuations, and if you just look at starting point valuations from today, emerging market, Chinese, and even foreign developed stocks are cheaper today than their US counterparts. So that's, I'm making kind of a broad generalization that you may have better valuations to buy into today if you look and are willing to look outside the US. Now, you either want to get into a company that you think the Chinese government can't take down, which I realize is difficult. You could buy a foreign market ETF and diversify so that you're not beholden to one sector or one stock getting picked on, so to speak. The other thing that this reader mentions is the US dollar. Typically, emerging market stocks do better when the dollar is falling. So tell me why then during the period of a strong dollar, about 6 months ago, did we actually see emerging markets do well? Typically, when you see a market do well against a headwind, when it should be enjoying a tailwind, you have to wonder what happens when that headwind turns into a tailwind. And that's really what we see in the dollar. So yeah, of course, emerging market stocks are going to be moved by the dollar. But all I was really pointing out in that piece is that there are periods where you have better opportunities outside the market if you know where to look, and you shouldn't be afraid to go where the money is.
I think that sums it up. You just go where the money is. The U.S. is the biggest. The U.S. market's been the biggest creator of wealth in human history, but it doesn't mean it's the best place to be at every time. There's other times emerging markets are better, or just non-U.S. markets in general are better. So I think you summed it up when you said follow the money. So one more question, and this is in reference to a chat we had a couple of weeks ago where we talked about gold. As a general rule, our group was fairly bullish on gold. At least we were bullish on the idea of having gold as a diversifier in the portfolio. Ron writes in to ask, can gold held in an IRA be physically held in your possession, or must it be held by the IRA custodian? So I'll actually answer this one. I'll answer this one. As a general rule, you don't want to mess around and push the limits with anything involving an IRA, because if you go too far on that, the IRS can essentially dissolve your IRA and then you're liable for taxes. So don't push it. If you want to hold gold in an IRA, go for it. There's nothing wrong with doing that. You can do it as an ETF. You can do it as physical gold. Like, that's something that a lot of people do. A lot of people do, and it's fine. But if you do it, make sure you're using a reputable IRA custodian and that they're the ones watching it. You don't want the gold sitting in your living room and then claiming it's in your IRA. That's when you'll get in trouble. So guys, that's going to wrap it up. Thanks for joining me today. I think this was very insightful for our viewers here. There are incredible opportunities in the months ahead. We're all looking kind of past this bear market into the next bull market to come, but there's still some money to be made on the short side potentially. So that's going to wrap it up. Adam's actually going to join me again next week, where we're going to develop this theme a little bit more, and we're going to go into more details about what that next big short is. So until then, safe trading.